one-on-one with Mr. Bond in conversation with Neil Parikh, CEO and Chairman of PPFAS Mutual Fund. The reason why we are meeting Neil is their 10 years of glorious wealth creation through their flagship scheme, PPFAS Flexicap fund. It has completed 10 years, amazing performance. Before I bring Neil onto the dais and share the screen space, let me explain to you how we rank mutual fund schemes. The current ranking system, unfortunately, is based on the recent past performance. Where based on the recent past performance, every 3 months, 6 months, 12 months, 5-star rated schemes become 4-star, or 4-star becomes 5-star, and so on and so forth. We have avoided doing that. We have created a ranking methodology which is very unique to the industry. It is based on the rolling returns analysis, and it shows the consistency of performance of any particular category or asset class. Based on that, on March 2023, if you had done last 1 year ranking of flexicap schemes, we give our audience and the viewers and the readers 3 methodologies of how to rank and how to analyze the scheme. Beating industry average. That is the first methodology, where over the past 7 years, since it's in equity as an asset class, we create data over past 7 years, daily 5-year rolling returns. Based on that, industry average in flexicap as on March 2023, for that any 5-year period was 11.13%. PPFAS flexicap scheme beat the industry average 81.81% of the times. Phenomenal performance. It is ranked number 1 based on that beating industry average. Next best was at 78.13%, and the 5th place in the top 5 of flexicap was at 61.89% only as far as beating industry average was concerned. So if you put this in perspective, you will realize how consistently flagship scheme of PPFAS has beaten the industry average. The second methodology is what we call IHR score, Investor High Return Score. Higher the returns in higher the returns band. So if you understand the rolling returns analysis, less than 0 negative observations, 0 to 5, 5 to 10, 10 to 15, and so on and so forth. If a scheme has delivered better returns in higher returns band, we give more weightage to that. Based on that, the Investor High Return Score of PPFAS flexicap scheme was 43.85, ranked number 2. The best was at 44.46, and 5th was at 36.73. And the third is the Investor Experience Return Score, IHR score divided by standard deviation. At what cost did the scheme deliver better returns? Was it more volatile, less volatile, etc.? Based on that Investor Experience Return Score, again, PPFAS was number 1 ranked out of 25 odd schemes which are there in the flexicap space. And on consolidated average basis also, PPFAS as on March 2023, based on the daily monthly rolling returns analysis like this, has scored number 1, and that also consistently outperforming the peers also, beating the benchmark also on a regular basis, and delivering excellent investor experience as far as investors are concerned. This is the glorious 10 years of amazing wealth creation showcased by PPFAS through their flagship scheme, PPFAS Flexicap Fund. Of course, it was recently based on the SEBI recategorization. But now let me invite Neil Parikh, Chairman and CEO of PPFAS Mutual Fund, onto the screen so that we can share some beautiful journey which they would have had during this period of last 10 years. And we will ask him a few questions on that. Welcome, Neil.
Thank you, sir. Thank you, Sunil bhai. Thank you so much for inviting me here today. I really appreciate it.
It's an amazing journey I'm sure you've had over the last 10 years, but I'm sure it could not have been a smooth journey all throughout. So what do you feel at this juncture of completing 10 years? Because I believe in 2013, when you launched your scheme, it was a 263 crore scheme, and currently you are at whopping 33,000 crores. Your first thoughts on this beautiful journey of 10 years?
So a slight correction there. We recently crossed 40,000 crores. So
oh my God.
we are
So
above 40,000 crores. So
amazing.
yeah, it's the journey has been surreal. The growth has been surreal. I think if you had have had this talk, say 4 or 5 years back, right before the pandemic, and you'd have said, okay, you'd have been a 40,000 crore fund, I probably wouldn't have believed it.
Correct.
I don't think those were in our projections at all. I'll be very honest with you. I mean, it's kind of a dream come true kind of a thing, you know. But the one thing we've always done, or over our course of our history, is that we never had.
You never chased AUMs. I know that for a
Never
fact.
chased AUM. We never had targets for anyone in terms of AUM, or any such numerical targets were not given to anyone. I think the focus was on investor experience, to doing right by the investor, and even investing where it makes sense, you know, doing common sense investing. So we never chased that, right? We never chased that, and it just happened. So it's real. I think one thing that makes us very happy, or makes me very happy more than the AUM, is that the sheer number of investors that we've onboarded. You know, so today we've got more than 21 lakh unique investors invested
Wow.
with us. You know, and that number was in the hundreds. You know, in 10 years back.
10 years back.
So that is amazing.
That's
So
a no mean achievement at all, Neil. It just shows the investors' confidence in how you manage money. Because I remember having various conversations with you when you only had one flagship scheme. So naturally, we were wondering as to, you know, why you not launching more and more schemes. So you had mentioned this to me, that our concentration is on delivering a very good investor experience. Now let me ask you another question. Now let's delve a little bit about Parag Parikh, the founder of this scheme, and your father, and his philosophy of investing. I believe he was a firm believer and an ardent follower of Warren Buffett and his style of investing. So a little bit more about how Parag Parikh was influenced by Warren Buffett, and what kind of style of investing did he bring into this scheme
sure.
to start with.
Sure. So what we did, say, in our PMS time, so we were running a PMS from 1996 to 2012, and post that is the mutual fund. So I can say pretty much for the whole last 20 years, the philosophy is kind of been the same, maybe a little smoothing of the edges, but on the whole, there are a few things that we believed in, and the few things that we do while investing. First checklist is management quality. Management quality is absolutely paramount for us. Again, we want to go with people who are minority shareholder friendly. If people have done something wrong in the past, then it's better to avoid such companies. Even newer companies, we want to see their track record. You know, we want to see how the management behaves over a period of time. So you won't see us investing too much in IPOs and the like, you know, in newer companies. So one is management quality. That's a big filter, and being in India, a lot of companies get eliminated by that filter only. So you're left
Absolutely.
with a smaller universe there. So a lot of work gets done on the management quality. Secondly, the thing that he believed in, and what we still do, is that we are buying a business, not a stock that will go up and down. You know, so
Absolutely.
we are partnering long term with a business. You know, so
typical Warren Buffett philosophy.
Exactly. So quarterly things can keep happening. We can talk a lot on the macros and stuff like that, but business decisions don't really change so much because of that. So what we're saying is that have patience. We want to partner with these companies, with these businesses for a long term, for a long period of time. So at least a 5-7 year horizon is kind of what we are looking for. We want to invest in business which has low to no debt and high cash reserves. I think in COVID time, we've seen how the cash reserves can be really helpful, and how a lot of debt can actually close your business down, you know. So
Absolutely.
having a lot of cash can make you have acquisition and get distressed bargains, you know, at these times. So cash is very important. Fourthly, we like a company which has some competitive advantage or some moat, as they call it. You know, we don't like too many commoditized businesses, because pricing war is crazy, and that just drives the price down, of things. It's good for the consumers, probably not that great for the
For the
investors
manufacturer.
of that company. So we
Correct.
look at monopolistic, duopolistic kind of businesses if we can get, and where there's not too much competition in that space, in that industry.
Right.
I think even with all these things there, I think one thing that we are very disciplined about is the right price to pay for the business, So that's kind of
Absolute
been
typical
ingrained.
Warren Buffett philosophy of investing. So,
Absolutely.
it's worked out wonderfully well as far as your scheme is concerned, your AMC is concerned. But let me ask you another question. In 2013, when nobody spoke about investing in the global markets, you were the only one who actually came up with a scheme from day one where you said we will invest 30-35% into global equities also. I think primarily into the US and of course the other areas also, like Europe and Japan, as and when the opportunities arose. What made you think, or what made Parag think on these lines in 2013? I mean, it's like, so much of foresight is all I can say.
Yeah, so I think a lot of credit has to be given to Rajeev Thakkar, our CIO.
Okay.
I think a lot of it is his thinking with my father. So a lot of credit goes to him. I think he was the one managing the PMS also that time. So he's been managing a PMS since 2001. And then he took over the managing the mutual fund. So he's been managing our funds for the last 20 years. So yeah, so a lot of credit to him because what we saw in 2000 post the financial crisis was that US stocks, global stocks were available very dirt cheap, and we wanted to participate in them, and in a PMS structure, you don't get to participate in foreign stocks. So
that was one of the thoughts of valuation based investing in US because of the opportunities. That's the reason why you came up with this idea.
Yes. So what happened during that time was that in the PMS you weren't allowed to invest abroad,
Right.
and what we did was for some of our clients who wanted to invest abroad, because we said that, listen, this is looking great. They're like, okay, open accounts for us abroad and you manage it, and we'll take advisory fees and stuff like that. Now that was actually a bigger pain than anything else. It was creating more friction because some people wanted to hedge the currency, some people didn't want to hedge the currency. Those who wanted to hedge the currency, and if the rupee depreciates, and every morning you have to call them, sir, margin call, which, and these are HNI clients, and they were like, what is this? I mean, I don't want to invest with you guys only if this is kind of going to happen.
It's an operational hazard on a daily basis.
Exactly. We thought we were doing something good, but it was actually kind of causing a bit of friction. So we're like, okay, this, what's a better way to go about this? Is there a better way to go about this? And one of the reasons to come out with a mutual fund was this. This is one of the many reasons why we thought about launching a mutual fund.
Awesome. I remember, Business India approaching me once, quite a few years back. And when they were doing a story on PPFAS and only one scheme in PPFAS basket. So their question to me was, Dakshesh, I think, was asking me this question, that Sunil, do you believe that PPFAS will sink with only one such scheme in their basket? So what is your thought? Is it good or bad? And my answer to that, which was printed also, was that, because they are concentrating and so focused into managing one scheme, where they are taking cash calls also, etc. So all that we will come to it a little later, that they don't have a choice but to perform. Fortunately, you have lived up to those expectations, and what I had predicted, that yes, it's good for the investors and good for the AMC that they are concentrating so much on one particular scheme. And I remember after you read that article, you reached out to me, and then of course after that we become great friends, and it's a mutual admiration society. Your thoughts on that piece of article and how did we interact with each other?
Yeah, I mean, I think you've answered your question, and in a lighter vein, if I might ask you, how many children do you have, Mr. Bond?
2 boys.
2. Why not 20? Similarly, I mean, like you answered, I mean, I think if you have only 1 or 2 kind of funds to run, you can put all your effort there, focus on that instead of cutting them into 20-30 schemes,
Correct.
then you're not kind of concentrating. So here, like you said, we had there was only one way to go. I mean, there was no survivorship bias, as they call it, right? In the sense that if you're running 20, 10, 20 schemes, multiple schemes, if you're running, then at any given time, some scheme is doing well. So you can market, marketing guys can market those schemes, and that's the way things run. So for us, we didn't have any survivorship bias. So it was very important that we do everything right. So we eat, sleep, breathe Flexicap fund, the PP Flexicap fund. That's all we could do, right? I mean, and again, more than even the investment, I think the communication was very important about this, So a lot of effort was gone into communicating very well. And obviously, I read that article about yours, and obviously there was a immediate affection towards it, because at that point nobody was talking like that, about us, or
you know, always seen as a negative aspect for PPFAS that time.
Yeah.
It
was I think 16, 17. I don't think it was much after that. I think it was and we were not even 1,000 crore fund. I think I remember. I don't even think we had reached 1,000 crore. So the initial years were obviously a struggle, and there was someone who was actually understanding some of these things we were trying to do. So it was very heartening for me that and obviously you obviously had that people were following you. You had a big name, and you had that experience going for you. So it was important for me to engage with you too, to figure out okay, this guy is at least talking my language. So let's get a game of golf with him, and that's how we started, right?
Absolutely. That's how our friendship started.
Yes.
So now let's talk about the challenges which you would have faced during this 10 years. I'm sure it was not hunky-dory. As you know, that 263 crores becoming 40,000 crores is not a linear line ever. Now, to come to a question as to the first thing which I can think of as a challenge was global investing in 2013, which nobody had heard of. Was that a challenge for you? And if it was a challenge, how did you overcome that challenge to convince investors to be with you?
So, like I said, we were running a PMS before that, right? So, and we already had about 150, 200 clients there, and it was easier to explain to them, because they obviously had a track record with us, and they realized how we were managing funds. So to them, it was okay. I mean, they had anyway shifted to a mutual fund, and we had told them that, listen, things are looking attractive in the US. But beyond that, it was a challenge, and the answers I would get, or the people would be like, listen, 2000 to 2010, US markets have not done anything. They're a mature market. There's no growth in that market, and it won't do any good. And more than that, forget anything else. You've mixed up that international investing with your Indian investing.
There was a major time correction in US markets.
Yeah, there was a time correction. Exactly. Time correction. Markets had given zero returns over 10 years.
Zero return over 10 year plus.
Yeah, and Indian markets have done much better. So I think the psychology is that you're obviously, a lot of people are obviously chasing some momentum, and that the best time to buy into something is when there is no momentum in that. So and that's what we went to tell people, that the best time to buy is when you don't feel like buying something at all. It was a challenge. It was a challenge for various reasons. One is that at that time, we were new in the mutual fund space. We didn't have a backing of a bank or a corporate or anything. We didn't have visibility. We didn't have a brand name. We were only launched one scheme where we were doing this international investing and Indian investing, and people were saying that this doesn't make sense. You should do international separately. You should do Indian separately, because the Indian market is doing well. So you should take advantage of that.
Why subsidize the Indian markets with foreign equity?
Exactly. So it was a challenge, and there was a challenge for the next 5 years. So I don't think we really convinced anyone that much in the initial years. I'll be very honest with you, but over a 5-year period, I think people looked at it. We had a track record, and the funny thing is that you were talking about challenges. I mean, today we are talking about 40,000 crore AUM, but we didn't cross 1,000 crores till 2018. So for 5 years,
correct?
In 5 years, we were a 700 crore fund for a longest time. I mean, 1,000 crores happened only in 2018. So
oh my God! And from 2018 to now, it's 40,000 crores, from 1,000 crores to 40,000 crores.
Yeah,
what a phenomenal leap!
Yeah, I know, right? So the initial struggles were very.
So it continued. That means from 2013 to 2018, you continued to struggle for various reasons.
For various reasons. Yeah.
And the second reason I can think of where you would have struggled is in 2013 you launched the scheme. Unfortunate incident happened in 2015 when your dad Parag passed away in Omaha in a car accident. How easy was it for you to maintain and retain the existing investors who were loyal to Parag to start with? Because you were, I don't know, how old were you at that time? How old were you at that time?
I was 33.
33 years of age.
Yeah.
And I think you were already into the business, but still, a young person coming into the shoes of Parag Parikh, which was a very difficult shoes to fill with. So how did you manage to convince your investors to stay with you? Was it a continuity of Rajeev being the fund manager which helped you, or was there any other communication?
Yeah. So the good part was I was in the I was working at PPFAS since 2004. So
wow, okay.
People knew me. It was 2015 by them, so it was almost a decade I was there. Obviously, I was just an employee. I was working here, right? I mean, I was a relationship manager at that point. I was looking after clients and distributors and stuff like that. When it happened, the first year, if I might say that the first year people were very easy in the sense that they were very sympathetic.
Sympathetic.
Yes, let me say, yeah, people were sympathetic, yeah. And the first year was not that tough.
What was the AUM at that time when he passed away? What was the AUM of your scheme?
It was about 550 crores, if I was mistaken, around 550. So we were able to maintain that for a year or so, 550, little bit up, down, a little bit up, not down actually. So that first year was actually pretty surprising for me. I'm like, okay, because when this happened, we thought there's going to be a run on the mutual fund, right? We had kept some money aside that, okay, if there's a run, then we need to pay people off and people need to pay the redemptions off. So there's always in the back of my mind or back of our mind that, listen, at any moment of time, people probably can come asking for their money back. And so the first year that didn't happen. Now, second year, we did see some redemptions. We did see some redemptions. And that
so
got
in the second year, what was your
we probably saw 100 crore redemption. From 550, 100 crores around.
Wow.
Yeah.
Almost 20% of your AUM went out.
Yeah. So that's a big percentage, right? We look at it as a percentage term.
Percentage.
Yeah. So 550, 575 went down to about less than 500. So that was something that was a little unnerving. I think that was unnerving that time. Again, communication was constant. That was important. I think one thing was that at that time I didn't think too much. I think that time the thought was about survival more than anything else. There was no much thought about where we are going to be and what we are going to do. I think the thing is that if people have trusted us with their hard-earned money, we better walk the talk. What we've told them, we better do that, and make sure we do that even better today, because our founder's not there. We have to walk on his and he had given us a great roadmap ahead.
Absolutely.
He was very chatty with me.
I'm sure the processes would have been put in place by then.
Yeah, I think the value system was strong, and I mean the best part was that a lot of the team has stayed together even today. So the senior management stayed back, and again, he was very chatty. He said that I don't care to be the biggest mutual fund in India, but I want to be the most trusted mutual fund in India. I want to be the most sought after mutual fund in India.
What a thought.
So that was something that stuck to us. We're like, okay, you know what? And he's told us these are the things we need to do. Communication, doing always right for the client, and whatever else, however we manage the money. So let's not get greedy about these things. And over time, success would happen. So we looked at the first 5 years as a startup phase. I mean, listen, nothing's going to happen in these 5 years until we get a track record, because like I said, we didn't have a name, visibility. Obviously, founders passed away. We're not backed by a big bank or an institution where we could just put in money in marketing and distribution, whatever it is. It was ground up, properly going.
If I recall, you were going more. It was not so much through the distributors, rather than it was more of one-on-one those days. If I recall,
I approached a lot of distributors that time, yeah, and we went and we wanted distributors on board, and we wanted like-minded distributors more than anything else, because we knew that this is, I mean, if you want to be successful here, you need the help of intermediaries, and at least for
Absolutely.
someone like us, we definitely needed it. We didn't have the reach. We didn't have visibility. We were working out of one office in Mumbai. Now, if you wanted some kind India visibility,
Presence.
you needed that,
Correct.
But one thing we did at that point, and we're still doing it, and in the beginning, it was probably looked down at, was giving the same commissions to everybody.
Wow.
Okay, so I mean, if you might be the biggest bank or an MFD who
So
just
they
got
were
his
all treated
license.
at par.
Yeah,
all the distributor channels were treated at par.
At par, everyone was treated at par. We said that, listen, we want sticky money, and the only reason we get sticky money is people who actually take time, understand us, and if they believe in us, then they'll put in money with us.
So you have the same philosophy even now?
I'm sorry?
You have same philosophy even now?
Same philosophy now. Everyone gets the same commission.
Wow.
It also helps us to communicate what we want to communicate, instead of just negotiating on.
It takes away the unnecessary noise of negotiating with distributors individually and saying I want more, I want less, etc., etc. So that really doesn't work.
Absolutely.
But having said that, 2015 was a tough year because of this issue also.
Yeah.
But you still continued to remain with one scheme at that point in time, and you've not changed that stand too much even currently. So I think you may be having 2 or 3 more schemes now.
Yeah.
Did you not think of launching new schemes at that time to shore up your AUM or showcase visibility, etc., or you continued with the same thought process? And where do you stand in terms of number of schemes now?
Sure. So thought process. So from one fund that we always had, that okay, we'll just have one fund. I think that obviously changed a little bit again. And what we realized, and we were we had a Flexi Cap fund, but everyone told us that was liquid fund to chahiye. Liquid fund you need.
Which is, if your money goes out of your system,
absolutely.
It needs to be switched into your own liquid fund.
Exactly. So at first we were saying that, listen, investment in anyone else's liquid fund, then do it. But we realized that it was 2-3 extra steps, So having a liquid fund was absolutely crucial. And once we had that liquid fund, we realized that, okay, you'll need 2 or 3 other funds to close that basket. You don't need to have multiple schemes or schemes just for
that. If I recall correctly, the next one was the ELSS.
The ELSS, exactly. So the reason we thought that, okay, we jotted down the reason we would launch a new scheme was, one, if we could do any simplification or differentiation to the scheme.
Correct.
2 is if it was a need of the hour, like a liquid fund or something like that, if it makes life for our investor easy by launching a tax saver or a liquid fund, then yes. And third and most importantly is that if you are excited to put our own money in such a scheme. I think
my philosophy in life is that my answer to a question, will I invest my own money in a scheme, is no. I will not put my investors' money. I'm saying it's a similar philosophy which you are thinking of at the manufacturer level, which is amazing.
Yeah, similar. So we started with the liquid fund was very necessary, and we saw after the liquid fund, a lot of stuff happened in the Flexi Cap fund. I think we saw a lot of
asset allocation basically happening between liquid to equity and
exactly. And we realized, okay, so this one fund maybe not the best way to go, but having a few funds which fulfills the need of a client might be the better way to go.
Correct.
After the liquid fund, a tax saver was something that we could easily launch, because our preference is to get into a Flexi Cap kind of, or a diversified strategy, and not be constrained by only large cap or mid cap or any of that. We wanted to run somewhere where we want to launch something which we could invest anywhere in that matter. So a tax saver played really well with our thing, and it didn't really need the same fund managers could run this scheme, and it's a 80% mirror of the Flexi Cap. So
absolutely,
that was quite easy, and that was the need of the hour for our investors, and even for some of us. We said that, okay, only India portfolio also makes sense now and all that. So that was there. And the fourth scheme that we came up recently was the conservative hybrid fund.
Right.
Again, there the need was of a debt fund, and this is kind of the conservative hybrid is a debt fund from our fund house. And there it came because a lot of people in our investors who had PMS investors had grown older, And they're like, boss, listen, I've invested with you guys in equity and all, but now I have to think about debt. Similarly, in our own households, if our parents were getting older, we're like, okay, a debt product to hai hi nahi either. So what's the best debt product for our own family or these people? And that's how the conservative hybrid fund came. So right now, there are 4 schemes that we are running right now.
Amazing.
Again, obviously, we've obviously had this debt taxation rule coming in, where
Are you going to tinker your hybrid fund to have 35% or more into equity to get that 3-year long-term?
yes, so that is one of the plans for sure, that the conservative can only go up to 25% in equity. So you're taxed at the full tax rate, marginal
That
tax.
means you may have to think of launching another scheme.
We are thinking about it, let's be honest. We
Okay.
are thinking about converting that into a...
What about balance advantage fund? Because that's a need of the hour. Practically all the fund houses have that, and I've been asking you to come up with a BAF for a long time.
So it will be in the hybrid category. So we have a few options. Actually, we're just evaluating that, that which is the best for us to run our strategy,
Sure.
So yeah, once we have clarity on that, that will happen. And the second, I think, the thing that we will launch, which is a lot of our HNIs have told us to launch, and the need for them is an arbitrage fund because of these taxation rules, that where they can get debt-like returns with equity taxation. So
absolutely,
arbitrage would be, so these 2 things are on the horizon now.
On the horizon. I remember reading an article in Morningstar where you had mentioned there is no I in team. I as in capital I. How did you groom yourself to be a team player and take your team along with you during this 10 years?
Yeah.
Or even earlier than that, I would presume.
Yeah. So I don't think there was any grooming required. I think I've been like this because I was playing a lot of sports that time when I was a child, like football.
But golf is a very I game.
Yeah, and golf is a very I game. That's why I didn't mention golf. As I played a lot of football and cricket at that point, and I knew what needs for a team to go ahead. My father was very, very vocal about these things. So a lot of that is also his learnings to me. Is like, listen, we're just one part of this. There's nothing else. You're just an employee of this, and we both are employees here. And we just need to contribute to how best we can to PPFAS, because it's just not us. There are 200 families, and like I said, more than 20 lakh investors. So we all are in it together, and do your thing to make yourself a little better tomorrow. So yeah, I think it came pretty naturally to me. In fact, more than the team also took me in. It's not like anything else that I did.
It had to be vice versa.
Yeah, I mean,
accepting you as a CEO.
Yeah. And today we are such great friends, and all of us have stayed together after this. So now it's actually like a family environment. So I'm so glad that happened, and obviously it took me time to obviously get also myself confident and assimilated into the team and be a part of that team. Though I was
being recognized as a leader, and
yeah.
So coming to that, so in continuation to what we were just discussing, Rajeev Thakkar, your CIO, has been there since, I think, Parag Parikh has been in existence. So he's a great brand ambassador, a loyal friend, a supporter of PPFAS, and a founder also, I would presume, as one of the founders. Not many people are aware of his contribution, and he's stuck through thick and thin during this entire journey. So what do you and how much do you contribute the success of PPFAS to Rajeev Thakkar?
A lot. Rajeev has been instrumental in our PMS since the start of our PMS days, and now with our mutual fund. And his role goes way beyond a CIO.
I can imagine.
Yeah, a CIO is just one part of what he does, but he's actually a mentor to all of us at PPFAS. He's the older, so he was my boss, right? When I joined, and also he was my boss. So he's kind of that. It's that kind of a relationship, I think it's a very easygoing relationship with him, in the sense that a very open relationship. I mean, he wants the best for PPFAS, and like you said, like you had also mentioned, that he's also an owner of it. He owns part of the of PPFAS also now. So we're thinking as owners. I think for us is, I mean, it's not like me the boss or anything like that. I think you all both are equally kind of.
He's a very grounded, very humble, very approachable person.
Yeah. I mean, I mean, if you ask anybody in our office, I think they all will say that he's our mentor and he's the one who, like, if you have any also problems and all, they will also go to him, you know. So yeah, so his contribution is goes beyond being a CIO, you know, and
Immense.
my father trusted him a lot. I mean, and there's the same thing here. My family trusts him a lot, and the trust is
Awesome.
mutual. I think what we do for him is that we give him the freedom to, not have any targets or not say, oh, the fund has underperformed in a year. What are you doing about it? No, I think he has that full flexibility to.
When there is no
And
pressure
I
of
think
targets, Neil, I have realized that then the sales team also, the fund managers, they are not pushed in a corner and taking shortcuts to just deliver returns for the sake of delivering short-term performances.
exactly,
This is
Sunil,
very
guys.
important.
Exactly. So one thing that we always have said in the our organization that we want to be professional, not business people.
Correct.
Professional is someone who acts like a doctor or lawyer who's supposed to do what's in the best interest of his client. Business person will do, acha kitna becha hai, bottom line kya hai, what is top line. We are not bothered about that. It's like telling a heart surgeon that, boss, you have to do 25 heart surgeries a month. Now by mistake
Unfortunate part.
you
Unfortunate
come
it
on
happens.
29th of that month and you have only a gas, he'll bloody cut open your heart, yeah. So we realize that, you know, we don't want that culture to come. Again, being the biggest or growth has not been that much of a focus for us. You know, it's all about investor experience and like we always mentioned. Listen, we do the good things, we do good for the client. Client again, when you're dealing with money, it's all about trust. If there's no trust only, then forget it. You're not going to get any AUM or anything. So I mean, just keep building trust, building goodwill, and
Absolutely.
over time things will happen. Yeah, I mean, have patience. You know, like not try to grow too fast also, you know.
Sure. So, I personally believe that it is the duty of the AMC and its fund manager to manage funds of the investors very diligently, what we've been discussing just now, and with prudence and with investors at heart first. For that, they must be cognizant of market valuations and not get carried away with our mandate is to manage money. So whenever you give me money, I will have to be 100% in equity. Now, many fund managers and many CEOs have made this statement that it is the duty of the MFDs and the investors to do asset allocation. It is our mandate is you give us money and we have to be 100% invested. But I have realized that since 2013 to now, the average cash holding of yours in your PPFAS Flexicap has been 13%, and in its peak, it's gone up to as high as 29% also. So you have taken cash calls, cognizant of the values of the markets, and based on which you have taken some profits off the table, been in cash to deploy at better valuations. Do you believe in this philosophy going forward also? Because now you are at a 40,000 crore AUM. It's not a small sum of money. To retain some in cash it will become a difficult proposition, and deploying that also will become a difficult proposition. But this I have seen that my smart solutions have failed as far as PPFAS scheme is concerned, because you yourself are taking cash calls. So your thoughts on that?
Yeah. So I think what we're trying to do is just do common sense. I mean, common sense investing. And for us, it's about doing the right for the client. You know, I mean, though he's given us money to invest in equities, but that doesn't mean we just invest anywhere at any price. Again, our whole thing that we tell our investors is that equity is a long-term product. It's at least minimum 5 years. If you have a horizon less than 5 years, don't even invest in equities, don't invest in our fund, don't invest in any equity fund. So having that 5-year horizon at least, then at some point when things are looking not that great, it's okay to take a cash call or not
Correct.
be invested, because it's an option to then you wait for a better opportunity to come, and we've seen that happen. So people are patient. They realize that this is a long game. It's not a short
So
game. It's
just
not
to
like
give you an example, sorry to interject, in October 2018, you were almost 28% in
yeah,
cash. According to my algorithm also, we were in the red zone where we would have been in balance advantage fund, conservative asset class versus aggressive. And in March 2020, when the markets collapsed, you were 2.9. That means that 28% was deployed into equity at the best valuation possible.
yeah.
So that philosophy has really kept you in good stead throughout this period, I would presume.
Exactly. So 2017-18, what you're talking about was when mid caps and small caps had gone through the roofs, right? I mean, and
Absolutely.
And that was a time that we realized that, listen, these don't require, there's overvaluation, there's frothiness in the space. So what we did was we sold off some of our positions, which we thought that, okay, we're getting a great deal for this, and we got cash on that. Now,
Correct.
that cash we didn't know, or we were not getting that great opportunities, though even there were stock prices in our radar. But like I said, we were very disciplined about when to buy such a stock. So we were like, okay, we will get some opportunity at some point, and obviously there will be short-term underperformance. That's a given.
Correct.
In our
Naturally, when you're
fund,
sitting on cash, there will be underperformance.
it's a given that there will be short-term underperformance. So we've been trying to tell people that only, that listen, you have to sometimes, underperformance is not that bad, because if you have cash in your portfolio, you can use it. So the next year in 2018, ILFS happened, and after that some of the stuff came down. We could deploy at least 10% of our things then. Then COVID hit, we were sitting on 14%. So over 2 years, we more than made up for that 4 or 5 months of underperformance,
Correct.
So our philosophy continues to stay the same. We will invest when it makes sense. Otherwise, we'll stay away. Being
Perfect.
cash is not a bad deal.
I'm very happy to hear that. Now let us put some data in perspective for our viewers. Total market cap of Indian equity markets is approximately 3.3 trillion, plus minus here or there, making it the 5th largest market in the world. Compare this to some of the stocks that you have invested. Now let's understand where you have invested. So Alphabet, which is Google, is 1.6 trillion in market cap. Microsoft is 2.5 trillion, and Amazon 1.29 trillion. Meta, which is Facebook, is 0.7 trillion. Total of these 6 or 7 stocks, or 5 or 6 stocks, is $6.09 trillion versus $3.82 trillion worth of total market capitalization of India. What appears to be large cap in the Indian context is actually small or mid caps, because these are mega caps. You can't even call them large caps, they are mega caps. So that mega cap is the story which you wanted to capture because of the global equity exposure, or is there something beyond just global equity? So is this mega cap story, which is not available to the Indian markets, looking at the valuations, etc., is that your thought behind investing in these mega cap stories outside India?
Yeah. So over our last 10 years, we've had a lot of international stocks, which are probably not the tech stocks that we have right now, but again, similar pedigree, like you said, mega caps and very big market caps. And just to go a little behind, the reason we want to go abroad, or we want to invest abroad, so let's say where we will invest. So we have restricted ourselves to North America, Western Europe, and developed Asia, which is China, which is not China, sorry, which is Japan and Korea and stuff like that. Again, going to these places, that at least the rule of the land we understand.
Correct.
A lot of stuff is got to us in English language, which is important. There have been issues where minority interests have been taken care of in all these countries, in these jurisdictions, and the
So
law
there's transparency at the government policy levels.
Legal
also.
system is fine, and things are going like it's fine. It's not like one of these smaller countries or some of these other countries where things can just be nationalized at the whims of one person or whatever it is. So there has to be some legal the legal system has to be pretty good in these places. Secondly, going abroad doesn't necessarily mean we want to gain more returns, or it's not for gaining more returns, it's for actually reducing risk in terms of diversification,
including the currency diversification.
Yeah, exactly, also currency diversification, as well as also not having country specific risk. So for example, if 100% of money is in India, demonetization happens in India, your Indian stocks will be affected, US will not be affected at all in that way, and vice versa. So again, stock markets go differently. Indian markets will go up one year, US market will be better the next year. So again, it actually protects the downside and gives a reasonable upside. Do that over a longer term, and you've got a low risk and a pretty decent return kind of a thing. And thirdly is, you're not getting all these opportunities in India, like some of the opportunities we have, that the big tech, Amazons and the Googles and the Facebooks and Microsoft, there's no alternative to invest here. So to invest, in all these innovative companies, you have to go abroad.
Go beyond.
So yeah, and again, one of the other thing is that most of these companies, they are part of their things part of their earnings coming from the US. Otherwise, they're very globalized businesses.
Absolutely.
So the other thing is we don't want to go into small caps or mid caps in the US.
Basically, all the Indian consumers are consuming some or the other products of all these companies, which are maybe based out of US or Europe, but they are actually global in its presence.
Absolutely, and they're not getting their earnings in only from one country; they're getting it from all over the country. So you're actually minimizing country-specific risk by a great deal.
Correct.
Again, if you're investing in a small US or any other country stock, again, you're taking a country-specific risk of that country, and which we are not very well versed about. So, for example, getting banks. You rather get banks in India than banks abroad, Banks run, and again, it's a very country-specific thing. So, banks is something we probably not go abroad to buy, but we'll want to go to the abroad to get companies which are usually not available in India. So that helps in risk management. And yeah, you're right. Mega caps is our preferred strategy to go abroad.
Sure. So, from 2008-9, the financial crisis times to now, naturally the US markets have done phenomenally well. So it's a one-way bull run. It came to a screeching halt in October 2021. And then, of course, now currently we are talking in terms of maybe there is recession, global recession, US recession, etc. And on top of that, RBI also stopped your purchases to buy stocks abroad. Now, two questions in this. One is that since your markets have collapsed in the US context, of course, they have bounced back to some extent over the last few months from Jan onwards or whatever. You expect the US recession will have its impact on the holdings which you have of these global stocks, number one. So is that an RBI freezing your limits on buying foreign stocks? Is that a blessing in disguise currently? Or do you see it panning out the other way around, that markets may do well abroad also, but we will not be able to participate due to this restrictions by RBI?
Yeah. So our ideal asset allocation, like you're probably aware of, in our FlexiCap, we would want to have that avenue to invest abroad. Let's be very honest. So that 30% has come down to about 18%.
17% or so, yes.
Yeah, I think it's 18.5 as of right now.
Okay, now.
Between 17 and 20%.
Correct.
So one thing is, something is better than nothing.
Right.
So having 70
to continue to reduce as in when you have more flows, and you'll have to invest per force in domestic market.
We will be, yeah, exactly. So the thing is that we'll have to invest in Indian stocks only, or domestic markets. We can't remit money outside the country. What we can do is, and what we've been doing is that the dividends whatever little dividends that we get abroad, we can reinvest that into the US stock, or we can sell one of our securities in the US and buy something else.
Okay.
So that's the thing. So we've done that. We've sold Suzuki recently, and we bought into 2 or 3 of the tech stocks that we already have, and some of the dividends we are reinvesting. But yeah, ideally, we would want to have that flexibility to invest abroad. And I think more so is again, we saw last year when again, like, there was a meltdown in tech stock. Yeah, in a shorter term, it looks like, oh, good, they can't invest, they're not getting into it because it was falling down. But when you look at hindsight, those are the best times to probably buy a little more of those things, right? So yeah, even if recession happens or whatever it is, and I don't know, we'll see how that goes about. You get good valuation, good opportunities to buy into those stocks.
Panic is profitable.
Yeah, exactly, and we look forward to buying it at those prices, So again, even before, let me also put one thing, that even before the tech crash happened last year, the stocks that we were holding, we were very comfortable holding that, because they were at 20, some of them were 18, 19 PE, someone Google and all were trading at 25, 27 times price to earnings, which was again reasonably priced. And if we could have bought more at that point. It obviously crashed and it's got back again. But the point being is, we are bottom up stock pickers. I think not too bothered about the macros as such, as long as we are getting opportunities in individual stocks, we will keep buying into those. So if it was open, the limits were open, or they get open, I think we would probably ideally would want to get back to 28-30% allocation.
Sure. So as a counter question to that, we have done an analysis which we will showcase during this interview only, is where Nifty 50 as the benchmark and S&P 500 as the benchmark of your domestic holding versus the global holding is just a benchmark which I have used. It can be a different benchmark as far as PPFAS Flexicap is concerned. When I've done, so let's assume that you were 60% in domestic equity, 20% in foreign equity. So I've given the proportionate weightage to Nifty 50 and S&P through this time from 2013 to 2023. And the outperformance has been phenomenal versus the benchmark. So once the viewers see that, if the total return was supposed to be say 16.5% in 2013 based on this benchmark, PPFAS delivered 29%, is 13% alpha. 2014-15 it was supposed to be 18%, you delivered 35%, and so on and so forth. Now with the, and a lot of it can be attributed to the foreign equity holdings also. With this freeze and with the restrictions which you have, you think the outperformance will start coming off, or will you only depend on stocks picking abilities of the fund manager in the domestic space?
Yes.
What should the investors expect going forward if the RBI does not increase the foreign equity limits and you are forced to invest only in the domestic space? Will that alpha continue to happen, and will you be number one in the flexi cap? I'm not saying that continuously in number one, but at least will you be in the top quartile?
Yeah, so just a little bit about, let's go a little behind in our history. When we were running the PMS, 1996 to about 2012-13, again, like I said, we were not allowed to invest abroad. So it was a only India portfolio, and we did reasonably well, I think, on average 17-18% CAGR over those many years, similar to what some of the flexi cap is kind of giving right now, around that range. So so it doesn't really bother us that, okay, foreign investments are close. Oh, we are just banking on foreign investments to for the returns, actually, that's not the case. I think foreign investment was one more avenue of flexibility that we got to partner to get into stocks that are not available here, or where we get good opportunities. So if that is not, so that's obviously ideal for us. We would want that flexibility. Now, on the absence of that flexibility, let's just see the other fund that we run, which is the tax saver fund, which is a full India fund.
Okay.
And it mirrors the flexi cap, plus it has 4-5 additional stocks, which are the which, because they can't invest in foreign stocks, that there are 5 additional stocks there.
Okay.
So if you see that portfolio over the last 4 years, it's actually done much better than the flexi cap.
Wow.
Yeah, so we are confident to manage it with or without foreign equities.
So you're not only depending on the foreign equity to deliver the alpha.
So Sunil, one interesting part is that over the last 10 years, our Indian stocks have done slightly better than the foreign stocks.
Wow. Okay.
Yeah. So
if you further do attribution of foreign versus domestic,
our stocks, what we have in our portfolio,
correct.
The Indian stocks have actually done slightly better than the foreign stocks.
Awesome.
Over the last 10 years. So
So investors be rest assured that even irrespective of whether they get the opportunity of investing in the global equities or not, the stock picking abilities, which is reflected in the ALSS, they will continue to perform the way they are performing, fortunately on the positive side only. Yes. Now the question, Neil, and I have done this analysis also, SEBI has recategorized a lot of these schemes. So there's a multi-cap scheme, there's a large and mid-cap scheme, and there's a flexi-cap scheme. Flexi-cap is where 65% has to be large, mid and small caps. Multi-cap is where 25 minimum in large, mid and small cap. And large and mid cap is where 35% minimum in large cap and 35% minimum in mid caps. After the recategorization, we have realized that the large and mid cap space has started doing better than flexi cap for 2 reasons. One, because most of the flexi caps are become very, very voluminous in terms of the corpuses, the way they are managed. So you are now almost 40,000 crores. Other flexi caps are similar. Naturally, per force, you need to be in the large cap space rather than in the mid or the small cap space. Is that a constraint for you? Your corpus is your AUM, is that a constraint for you to deliver after alpha going forward because you have to be in the large cap space? That is first question. And you may or may not be able to get into the small cap space only because of these sheer volumes now.
Yeah. So sure, those are conversations that are there in the organization, and we keep having this conversations. And what's the best way to go about this, with size and stuff like that. So I don't think size is that big a constraint as of right now for us. The reason I'm saying is that if you just look at the equity, so we are managing about whatever 40,000 of all the schemes we have, but 35,000 is about flexi cap. So we are managing pretty much 35,000 flexi cap and 1,500 crore tax saver in the equity space, which is about 36.5, 37. Compared to us, other fund houses are managing more than a lakh of crores or whatever it is of equity. Now, what we've seen is that, listen, if you're managing equity funds, and the one thing is you run one big fund, or you chop it and change it to 10, 15, 20 funds. In effect, your buying is going to be the same. If you want to buy 100 shares of Reliance, you buy it in one scheme or you buy it across that many schemes, your impact would be the same. So I don't think size is a big concern right now. It's not that much of a concern right now. What happened? There are some changes that definitely happened. So let me just point that out. So one is that what we thought was ideally a 25 to 30 stock was an ideal allocation for our fund, which surely will go up now. I mean,
if you want to increase the number of stocks,
meaningfully participate in small and mid caps, that would go up to about 35. So we'll have a longer tail. Obviously, with size, one thing is that you can't buy 4% of a mid cap, smaller cap stock or whatever it is. It creates a lot of things. So it basically might as well buy 0.5% in your portfolio of say 5-10 of these stocks.
Right.
So one will be that change will happen. Secondly, the time to buy small caps and mid caps is probably not when everyone is buying small and mid cap stocks. What we have seen,
if the time to buy is now, maybe.
So what we have seen in our time is that when things are bad for small and mid cap, and small and mid caps will go up very fast and will come back also very fast. That we've seen.
It's both sizes accentuated.
Both sizes that. So one thing is that we have bought into a lot of the small and mid cap stock when things have gone, when everyone is selling those stocks, or that's the time to buy it. If you start chasing stocks when everyone is buying,
you have nibbled into the small cap space.
Oh yeah. We've always had. So one thing is that the profit pool of corporate India is 70-75% is anyway large cap. And the rest, whatever, 25%, so 8-9 will be small cap, the remaining 13-14 will probably be mid cap. So that's where the profit pool is. So in essence, you have to go, so the large caps have provided that profitability to in corporate India. So having a bit of large cap, and right now we think large cap has a little more value, is providing more value than mid caps and small cap. But when things go bad for small and mid cap, listen, getting volume is not a big deal at all. The time, the day you don't get volume is when you start chasing small and mid cap when everyone is buying. That's when the impact cost goes up. That's where a lot of things happen. So yeah, it's about being patient in these. It's like you have to pay a slight cycle. So
sure.
So that's kind of where we are right now. We might be a slightly more cautious because small and mid caps are a little more expensive than large caps. So you'll see a large cap bias now, though we have small cap stocks in the portfolio even right now. But what will happen is that, over time we will have, we want to participate in being a flexi cap. We want to have all caps, large cap, big cap, small cap. The thing is that we will probably the top 10, 15, the top 15 stocks should be the same, which will be about 75% of the portfolio. But there'll be another 25 stocks which might be in the smaller space, which will be the remaining 20-25% of the portfolio will be in those stocks. So that's kind of what we are looking at going forward.
Now the hot topic, the SEBI recategorization of the TER and the expense ratios, etc., whether at the AUM level, at the AMC level, if they are going to be having a separate TER for equity, which will be slightly higher than on the debt side. Do you think that your style of investing, which is going to be based on the valuation, you may be in cash, but the transaction cost will go up? Because now they are saying that all the transactions, your STT, your brokerage, your research reports, etc., have to be part of the TER. Do you think that buy and hold will now rule, or will you still be dynamic enough to do in and out of stocks as in when you see the values or see no value in those stocks? Will this SEBI consultation paper restrict not only you but the other fund managers also to be more buy and hold and equity oriented approach versus more transactions and cash oriented approach.
Yeah, so let's talk about ourselves only. I don't want to speculate on other fund houses and what they would do, but obviously a very high churn will obviously increase cost, which anyway does, so that might be maybe a bit affected. But again, we are not in that boat. What we are saying is that, say, if let's just take a cricket analogy, for example. You go to play a cricket match, you don't have any control of the pitch or the weather. You can only play your game, right? So whatever pitch or weather or whatever environment we have been given, we have to work and play our game in that. So we are not that bothered about we will not do a trade because transaction costs will go up. That's definitely not what we are trying to do or trying to maximize on the transaction cost. I think if it makes sense for the end investor that this action will be beneficial to that person over a longer term, we will go ahead and do it. I mean, if things are...
But your balance sheet will be affected. But
might be little affected. I think when we look at it, it actually might be positively affected for us. So I think talking about just doing some basic numbers and stuff like that, I think the top 8-10 AMCs will probably be affected in terms of their profitability. I think beyond that is actually positive for smaller and mid cap.
I saw that analysis where the small and the mid cap space AMCs will be positively benefited versus the top 4 or 5 large cap large AMCs.
Yeah, so there will be beneficiaries and there will be losers also. They want a level playing field for everyone. So
let's see finally with which format and what consultation papers, what recommendations are taken on board by SEBI. And accordingly, let's see where it takes us. But Neil, I want to thank you so much for coming on this show during this 10th year of a decade of phenomenal performance, consistent performance, huge wealth creation for your investors. That focus which you have not lost of investor first and the rest will follow. I commend you on that and your team on that, and wish you all the best and success for many decades of wealth creation for the investors.
Thank you so much. Thank you so much, Sunil bhai, and you've been a well-wisher for us, and thank you for that. And I look forward to many more conversations with you.
Absolutely. It was an amazing conversation, and it was nice taking you on the path of that last 10 years journey of your AMC and your scheme. Thank you.
Thank you. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.